Good afternoon, ladies and gentlemen. The party on Dalal Street continues. It was a gap-up opening, and after which you did see some amount of profit booking, but bulls are running in strength on both the National Stock Exchange and the Bombay Stock Exchange. 675 points higher on the Nifty as we speak. The rally is now expanding. You have gains coming across the board, and the advanced decline ratio is very strong, all because late last night, somewhere around 10 p.m., both Indian and US economies, as also the top decision makers, tweeted that the much awaited Indo-US trade deal is now back on track, with reduced tariffs for Indian exports, and of course a broader market opening up for the US as well in the Indian economy. Be that as it may, there has been a smart reversal in the fall of the rupee as well, and all seems to be well on the Dalal Street. But is that so? To discuss this and a lot more, we are joined by Mr. Amit Goel, co-founder at Pace360, a very well-known PMS company which deploys cash across different assets. Namaste Amit ji, a very warm welcome to you, sir. You've been one of the naysayers on Dalal Street as far as equity is concerned. Do you change your stance at this point of time after a great trade deal with the US and of course the one that happened with the EU recently?
So I agree with you, Shail. There have been quite a few positive developments, and I think as you mentioned, the trade deals are definitely a tailwind, and I think the benefits of the GST relief which was given, they are also coming in. They are coming through. So a good part of the gains have been made in the previous quarter, but it is my assumption that this being the Q4, which is typically the best quarter for a lot of these auto, consumer durable and manufacturing companies, I think this quarter will also pan out pretty well. And with this, particularly the US trade deal is a very important tailwind, because this had caused a lot of consternation. It had caused a lot of unemployment in many parts, in many industries. So there is a feel-good factor attached to it. And it was my assumption running into the budget that the budget is probably overhyped as usual, and nothing substantial is going to happen in the budget which will give the which will cause investors and traders to become bullish immediately. But of course, I had no idea that the trade deal with US would happen just one day after the budget. My sense is, Shell, that we are in a sweet spot right now as far as the Indian markets are concerned, because we have underperformed very, very significantly over the last around 18 months. We have been one of the worst performing major equity markets of the world. We have also been one of the worst performing major currencies of the world. And this trade deal, and plus the other factors that we often speak about, they do give some sort of a background or a backdrop for investors and traders to not write off the Indian market, but to look at it again very, very seriously and see if some of the investments which the FPIs had made in some of the emerging countries like South Korea, Taiwan, China, Poland, and many others, whether, with those 50, 60, 70% gains, are they now at a point where they are reaching some sort of a stagnation or a saturation, while India is just beginning to look up? So my hope is that this is a sweet spot rally that could happen over the next 2 to 3 months. And relative outperformance by India is almost guaranteed in the next 2 to 3 months, Shell.
Okay, so now there is a change in thought as far as Amit is concerned. He was a bit bearish when we last spoke to him, and that's fair enough, because at that point of time, whatever was the state of play of the markets warranted that thought, and this overnight development does. In terms of sheer underperformance, ladies and gentlemen, let me just put this out to you. In terms of major indices, if you see, the Korean Kospi, which is at one point of time something that we used to look forward to, in last 12 months is up 1.5 times. Even the Karachi Stock Exchange is up 66%. Look at how things have improved for the Japanese markets, for the Chinese markets, and at all this time the Indian markets have been very, very heavy underperformers. So mean reversion is on the cards. Trade winds are improving for India as far as the US and the EU trade deals are concerned, and now of course this sentiment booster that has now come in, as also the rupee has also started to appreciate. Amitji, at this point of time, what would you be doing with the customer investment money? What plans to deploy fresh capital at this point?
Yeah, so Shell, we've been pretty fortunate that through most of this underperformance by the Indian markets, we have been earning a safe and secure return through our fixed income portfolios, which are currently, which have been giving us about 11% per annum. And plus, off and on, whenever we felt that equity markets have they have corrected too sharply and they are probably headed for a bounce, we have added to equities, and then we've managed to sell them at a reasonably, I would not say big profits, but a reasonable profit, just to add to that 11% per annum fixed income return that in any case accrues to us. So as of now, we are at about 20% invested in equity. If we had an inkling that this trade deal could happen so soon, maybe we could have gone up from 20% to 40-50%. But now, of course, that has already happened, and we've seen a massive jump in the Indian markets today. So what we would now do is that every time there is a correction between now and mid-March, and that from the beginning of February till mid of March has usually been a weakish period for the Indian markets, everything else remaining the same, which is of course because of the year-end considerations, the advance tax and the liquidity considerations. This year, of course, this trade deal has kind of changed the situation a little. But what we are going to do is that between now and mid-March, we would look for more opportunities to buy into the market. And we would then sort of by mid-March, we will probably be at about 40-50% equity exposure. And we would then look forward to a new financial year rally, and the sweet spot rally to continue till about April or maybe early May, which is when we would actually look to sell some of the some, or rather in fact maybe all of the equity exposure, because we haven't changed our long-term outlook, Shell, not on India and not on the global markets. It's just that because of this huge underperformance, we were destined to have a sweet spot rally, which has now been sort of expedited a little by this trade deal with US.
Fair point. And one is entitled to have one's view, deploy your own capital, as also of clients who trust you, and then change your view when the situation so warrants. Amitji, at this point of time, we are also in a sweet spot because the mega bubble that was there in silver and gold seems to have bust, and a lot of money from that side should also come into underperforming equities, as also the mean reversion that you and I have just discussed. Now, because you say that you will be buying all dips, what are you interested in? Are you looking at US focused companies that were beaten down terribly? Are you looking at earnings outperformers? What catches your fancy? What is your research team looking at?
So basically, Shell, we would be adding to diversified bets on equities over the next 4 to 5 weeks, and we would, for example, add Nifty Next 50, which has significantly underperformed over the last 1.5 years. We would be adding to private banks. We would be adding to defense, though, of course, some people feel that the world is now becoming a little more peaceful. So maybe defense would not be as much in vogue as it has been over the last 1 year. But I do definitely feel that the defense budgets are not going to come down anytime soon. So I think we would be buying into many of these sectors. And as far as the impact of the trade deal is concerned, yes, we would be looking to add some of these food export companies, particularly those seafood companies, and then, of course, some of the textile companies. But because of this massive jump that we have seen just between yesterday and today, we would probably see if there is a profit booking at some stage, and we get them slightly lower than where they are today. They would obviously not come down to the levels that we saw yesterday or day before, but they could come down a little from where we see them today. So over the next 4 to 5 weeks, we would be adding to our diversified bets and some of the sectoral themes that we like, and of course some of these stocks and sectors which benefit from the India-US trade deal, but maybe with a little bit of a correction or a profit booking from the current levels.
Fair point. Look at Avanti Feeds, ladies and gentlemen, India's major shrimp exporter to the US, up 20% circuit on very, very heavy volumes. About 14 crores worth of transactions have happened on Avanti Feeds. And look at LT Foods. These are all companies that were under the grip of bears not till very recently, and have shown a sharp spurt in price volume the moment this deal was made public and investors got a chance to come back in. A view that you would share on metals and banks, Amit? These were two sectors that held sway at a time when there was pain on Dalal Street. Bulls were rampaging there. What now?
So, Shail, I think that's a very, very important question. And it is my understanding that that this huge commodities build-up that we saw in the last few months, we've seen the best of it. And particularly on the precious metals, I'm now reasonably sure that that this massive bubble which got inflated over the last 6, 7, 8 months has now begun to deflate. But I must point out that the first fall, when a bubble of this size and enormity, when it begins to deflate, usually the first fall is the most dangerous, and it almost looks like an Armageddon for investors. And I think that has happened between Thursday and yesterday. So my feeling is that we are headed for a relief rally in precious metals. And the first relief rally after the first fall is also usually powerful because the long-term conviction is still not shaken up too much. So as soon as they begin to rally, a lot of traders and investors will feel, okay, look, they were overheated, they've corrected, and now they'll go back up again. So my feeling is that they are headed for a relief rally, and I would want to see silver at about $100. And I would want to see gold at about $52 to $5,300, or maybe even $5,400 within the next few weeks. But I think overall the commodity build-up that we saw is more or less behind us. I mean, at least the best part of it is behind us. Maybe the industrial metals will do a little better than precious metals for now. So I would want to keep out of the commodities stocks because they have seen a lot of frenzied buying over the last few weeks. And I would not want to participate in them, even though I believe that there is a relief rally in the offing for precious metals. As far as the banks are concerned, I think they could rally more. If you look at Bank Nifty, the P ratio of Bank Nifty based on trailing earnings is still less than 17. So that's considerably cheaper than practically any other broad-based index in India. Or for that matter, even any sectoral index in India. So it is my feeling that banks can continue to outperform for the next few months. And some of the laggards like HDFC, which have just not performed at all for such a long time, probably it's time that they started performing as well. So while out of the two sectors you mentioned, I definitely feel more positivity towards the private banks, and even the PSU banks should do well. But I'm not so sanguine on the commodity stocks considering the frenzied buying that we saw over the last couple of months.
Fair point. And everybody knows that a phenomenal amount of money has been made on the commodity space on equity side. So that's the structure of Amit's thought process. Any views on chemicals and pharma? These are also very, very big beneficiaries of the US trade deal. Many chemical stocks have surged sharply. How do you see any underperformers or relative underperformers that you have in mind which could be added to your kitty?
I'm actually quite positive about chemicals and pharma as well. And we may want to do some buying in those sectors as well. We have a small presence in some of the chemical and pharma indices, not necessarily individual stocks. But I do feel that they should have more upside in them over the next 2 months. So, Shail, my understanding is pretty clear that beginning of the new financial year, there is just one caveat that I would want to give, that I hope that the AI and the technology bubble does not get burst completely between now and then. So, if there is no major turmoil in the global markets, then my sense is that by April, which is just 2 months away, we could be at all-time highs on Nifty, and of course, Bank Nifty made a new all-time high today, so it will probably extend its all-time highs. And many of the other indices would also probably go towards their highs or maybe make new highs. I doubt that small cap and mid cap indices will go back to their highs, because they are truly they were extremely overbought. And I don't think that those excesses have been washed away yet. But I think large caps should do better, and some of the chosen mid caps will also do better. Chemicals and pharma, I think they will do well. And between now and mid March, we are probably going to increase our exposure to both these sectors.
Okay, fair point. And my final question to you, Amit, what are you not even touching with a barge pole? What does not look good? It could be valuation, it could be price, it could be a combination of low volume, it could be a combination of zero returns and zero growth. What doesn't look good?
I would say that small caps and micro caps, I mean, that is a space that in any case we normally do not like at this stage of the cycle, Shell. So normally the small caps and micro caps would do very well in the initial stages of any economic boom cycle. And we have been in one such cycle now post COVID. It's going to be almost 6 years in the next few months. So at this stage of the cycle, one should clearly avoid micro caps, one should clearly avoid small caps, and also the very overvalued mid caps with P ratios of anything north of 30, unless and until the fundamentals are so good, or it's such a massive turnaround case that the company is turning around from losses and it's going to go into major profits. Except for those isolated cases, I think we'll probably avoid them. We are going to be in this rally only for the next 2 to 3 months, and this is a tactical ploy for us. So longer term, we are not sanguine, because we still do believe that US is headed for a recession over the next 2 to 3 or maybe 4 quarters. And India is by no stretch of imagination an undervalued market. But because of this massive underperformance, and because of these tailwinds that we've got in the last few days and also in the last few months, I think we are now almost destined to revert to the mean and sort of make up for some of this massive underperformance, which is a historical underperformance. It has never happened before in the last 30, 40 years. And I think there is going to be a reversion to the mean. But yeah, small caps and micro caps and any overvalued stock with a P ratio of more than 40, 50, we would probably want to avoid them.
Right. What a wonderful, wonderful answer, Amit. And as they say, live in the present. So till the rally lasts, we'll enjoy the boom. And when the pain comes, we hope to have the endurance to bear it. Thank you so much for your time. And we'll be meeting very, very soon, especially in Mumbai. And here's wishing you all the best.
Thank you so much, Shail. Thank you.
Bye-bye. That, ladies and gentlemen, was Mr. Amit Goel. A fantastic view on the market. Bullish for the short term as the Indian market mean reverts to sanity after 18 months of pain, in which other emerging markets have gone up substantially. And now with the tailwind of two major trade deals, we see some hope for bulls. Thank you for watching. Please stay with Business Today.